Good afternoon, everyone. I'm Vanessa Grossel, Advancement Manager, and it is my pleasure to welcome you today as we continue to celebrate Innovation Month at the Council of State Governments. We hope you will find value in today's program and have enjoyed tuning in each Monday in May as we host these virtual innovation classrooms on a broad range of topics, from healthcare to technology. Today's innovation classroom, Understanding Smart Finance and Enabling Bright Financial Futures, is brought to you by Security Finance. And now a few reminders before we begin. This session is being recorded, and at the conclusion, it will be posted on the CSG Virtual Innovation Classroom webpage. We encourage audience members to type any questions that arise at any point during the presentation into the Q&A at the bottom or the chat area at the bottom of your screen. And we will reserve time at the end to address them following the presentations. But for now, why don't you go ahead and tell us in the chat which state you are tuning in from today. And now I'm pleased to introduce today's speakers. Tracy Sandin, Senior Vice President, Government and Public Relations for Security Finance, and Dr. Harold Black, Emeritus Professor of Finance at the University of Tennessee. Thank you for participating with us. And now I turn this program over to you.
Dr. Black?
Oh, hello, how are you? I thought you were going to start, Tracy. I'm sorry.
Sorry.
I'm sorry, do you want me to start, Tracy?
Yes, thank you.
Oh, I'm sorry.
Yeah.
I don't see my slides. I'm sorry, Tracy.
Okay, so maybe we can get somebody to help share the slides because I can't do it.
Of course, 1 second.
Thank you. And Dr. Black, you're going to have to instruct him when to
There
switch.
we go. Well, this talk is on understanding smart finance, helping the subprime borrower. The reason we are saying this is because consumers are facing uncertainty and the loss of financial standing, because lawmakers are being convinced that rate caps are the only way to protect consumers from predatory lenders. Now, we all agree that trapping a borrower in the cycle of debt is dangerous to the consumer. However, small dollar lenders actually use models to move the consumer out of debt and help build or rebuild credit. And the proposed interest caps, called usury ceilings, although purported to be in the best interest of the consumers, are not, because they actually make consumers worse off, forcing them to go to less responsible lenders, pay higher interest charges, and are welfare damaging to the consumer. So how do you protect the consumer? Next slide, please. First off, understand that usury ceilings are among the oldest of all consumer protection laws. They go back over 2,000 years. I have a quote here from Aristotle. Aristotle said, "Money is sterile and should earn no interest." The Catholic Church said that usury was a cardinal sin and Catholics could not lend in the Middle Ages. So the money lenders were the Jews. And even today, all of the major banking houses in Europe are owned by Jews. In America, all 13 colonies mandated usury ceilings. At the turn of the century, of the 1900s. There was a study that looked at the cost to lenders and said that an interest rate of 3 to 3.5% per month would cover those costs. Now, understand, we're talking about costs in 1900. That was the Russell Sage Foundation. But that 3% per month is the origin of the 36% APR that is now so popular. Now, one thing to keep in mind, remember I said that these laws were around for 2,000 years? Well, one would think that if they've been there for 2,000 years, we would be able to find evidence of some help to the consumers. That evidence is rare. It is few and far between. On the other hand, there's a tremendous amount of evidence of the harm to the consumer. When we look at interest rates, we know that interest rates are determined in competitive markets. Interest rates for car loans, interest rates for mortgages. Now, if you arbitrarily dictate an interest rate, and that interest rate is below what the market will charge, then there's going to be fewer loans made by the lenders and excess demand on the part of the borrowers. And so many subprime borrowers who would ordinarily qualify for a loan at the higher rate won't qualify. So what happens to that money? Actually, that money, all the research shows, goes to borrowers who are better off, have higher credit scores. And in many cases, research shows that the usury ceilings do nothing more than affect the wealth transfer from the subprime borrower to the wealthier borrower, leaving the subprime borrower with few, if any, options for regulated and affordable credit. They are left to seek other forms of credit that are more costly and make them worse off. So, who are adversely impacted by usury laws? First, there's the unbanked, those that do not have accounts at traditional financial institutions. They rely on alternative financial services. There's the underbanked, they may have a checking account, they may have a savings account, but they also, mainly because of low credit scores, utilize these alternative financial services. Around 30% of all households are either banked or unbanked. They have lower credit scores, they're classified as subprime, and many of these are customers of our small dollar installment lenders. Why don't they use regular depository institutions like banks? Well, there are barriers that are that limit access to those services. For instance, minimum balances. Also, there are very high fees on overdrafts and late payments. Many do not take as customers those with credit scores below 650. There's a lack of locational convenience, if you will, the credit desert. And that is, there are few, if these, of these types of institutions located in neighborhoods and MSAs where there are mainly poor people. There are long decision times on loan approvals, and many have a lack of proper identification. So why use non-bank lenders? Well, those users will find non-bank financial services to be much more convenient, much faster, less stressful, more user-friendly. Traditional financial products are not designed to handle the risk of these underserved banking public, not responsive to their needs. So the underbanked characteristics with these low account balances, the need for small dollar loans, accounts that are more labor intensive, limited negative or no credit history, make traditional products not feasible for this population. while the non-bank lenders, these small dollar installment lenders, are able to be more responsive. They offer locational convenience, expedited services. Proper loan payment can help build credit, build and help the transition borrower into being credit worthy. In economic downturns, heavy regulatory limits, depository institutions cut costs by limiting access to its least profitable customers, the subprime customer. Banks and credit unions have a fiduciary responsibility to their boards, to their members, and there are legal and regulatory limits on extending higher risk loans. Let me give you an example. When Dodd-Frank was passed in 2010, one of the heads of one of the largest banking companies in the country said the following: because of the cost of implementing Dodd-Frank, we will no longer be offering credit cards to approximately 15% of the customers who we currently serve. This is mainly because we deem them too risky in the light of new regulations restricting our ability to make adjustments over time as the client's credit risk profile changes. So those customers are actually abandoned by this traditional lender and is left out there with little choice when it comes to the traditional lender. So look at the impact of decreasing credit options. There's a considerable statistical literature out there, and here's what it shows. If you impose interest rate caps, they hurt those who are in debt by increasing foreclosures, defaults, and bankruptcies. There is an increase in domestic abuse and divorce after those credit caps are imposed. And the financial stress often worsens as borrowers are forced to shift into alternatives where underwriting based on ability to repay is not available, such as high revolving credit card debt, pawn shop transactions. There is considerable evidence that financial welfare is decreased by interest rate caps. What are the arguments that are typically given supporting rate caps? One, the subprime borrowers are naive and uninformed. Research shows that's not true. The research shows that the subprime customer understands the cost of loans in terms of dollars, but not in terms of APR. There's considerable evidence to show that they even shop those dollar costs among different providers. So customers are interested in the payment size and the dollar amount of the interest paid over time. And as I said, they actually compare these costs with various lenders before they make a decision. So they are not naive and they are not uninformed. The second argument is they're most vulnerable to exploitation, simply because they're typically unbanked or underbanked. Well, in the case of an emergency, even while credit constrained, customers are still aware of the conditions for a small loan and must be advised of the laws and regulations. The evidence shows that higher concentrations of small dollar lender mean more choices for customers and competitive rates on loans, making them less vulnerable and less subject to exploitation because they have a choice that they can afford. Another argument is that high rate lending destroys consumer welfare. This is that cycle of debt hypothesis. And so this hypothesis says that high rate customers should be protected from themselves. Implication is they're being lured into borrowing and can't extricate themselves from their debt burden. This is the debt trap. But the debt trap hypothesis would also imply that these households would have fewer borrower financial problems once small lenders are eliminated through the use of these usury ceilings. The truth is just the opposite. Statistics show that when you have interest rate ceilings, households bounce more checks, there are more complaints about debt collectors, they're more likely to file for bankruptcy. And so consumer welfare is reduced and not enhanced. And importantly, studies show that households who live in states without interest rate caps are less likely to be turned down for credit and actually do not report higher levels of debt. Again, this argument about destroying consumer welfare. In one state, the imposition of rate caps caused regulated installment lenders to cease operations, while depository lenders often stopped making small consumer loans. But the pawnbrokers and unregulated online lenders proliferated. Commercial banks and credit unions rationed credit by increasing the minimum size of the loan to more than 2.5 times more than average minimum size of the loan outside the state, in effect discriminating against small loan borrowers. Impact studies show an increase in loan rejection to those in the subprime market. Again, we're actually destroying consumer welfare through the interest rate ceiling. Consumers who are unable to find credit at the rate ceiling substituted credit from pawn shops, point of sale credit. In point of sale credit, it's been shown that when the customer buys the merchandise, the merchant marks up the merchandise because they cannot charge a higher rate for the merchandise. The implication is that usury ceilings or welfare reducing force higher risk consumers to patronize pawnbrokers, incur higher prices on consumer purchases than states that are not, where customers are not similarly constrained. By the way, the affluent can borrow out of state and find that they do not have this funds being constrained during the emergency. Again, there is a welfare transfer from those that are constrained to those that are not constrained. There's also this feeling that high rate lenders, because they charge higher interest rates, make abnormally large profits. Once again, all of the data in the study show that this is not true, that the small consumer lenders have lower profit margins than consumer banks. Yes, they charge more, but they have higher fees due to the higher operating costs and annual inflationary charges driving labor costs. The high cost of convenience results in these high occupancy costs, high wage costs, high fixed costs associated with writing those small loans. Let's have the next slide. We have a national example now, and that's the Military Lending Act. Some people say it's working, should be extended to everyone. Well, let's look and see if it is working. As you probably know, Military Lending Act became law in 2007 and was basically all inclusive except for auto finance, mortgages, and credit cards. When it was enacted, several major lenders withdrew from the military market, making it harder, if not impossible, in many areas for service members to obtain loans from installment lenders, banks, and credit unions. I know you say, well, what about those military credit unions? Interestingly enough, 86% of military credit unions shrank their payday alternative loans. 11% eliminated share secured loans, discontinued indirect card lending, unsecured lines of credit, overdraft lines of credit, and our credit cards. Now, some military borrowers have gone so far as to deny their own active duty when they make their loan applications just to gain access to higher interest loans. There is considerable evidence that some service members have resorted to borrowing from predatory lenders. Therefore, we see the same impact that we've seen throughout history when it comes to the Military Lending Act. Let's talk about APR, because that seems to be the nexus of the problem. Is APR an appropriate metric for use in short-term lending? In a word, no. Because evidence shows that consumers are more concerned about the total cost of the loan rather than APR. And APR is a very poor predictor of borrower behavior. Consumers know that the following fees are higher when calculated as APR than borrowing from short-term lenders: bounced checks, late fees, overdraft protection, and ATM fees. In my class, I ask students to calculate interest payments on a mortgage. I say you have an APR of 4.5%. It's a $200,000 mortgage, yielding payments of, this is for 30-year mortgage. It yields total payments of around $364,000, or a total interest payments of $164,000 on a $200,000 4.5% mortgage. My students say, how's that 4.5%? Well, that's an excellent question. And I bet that if you put this question to most audience, including those of legislators, you will get the same answer. How is that 4.5%? It's because APR is a measure of time, not the cost of the loan. Look at this example. Given a $100 loan with an assigned 1% in total interest costs, you pay it back in 1 year, APR is 1%. If you pay it back in 1 hour, APR is, as you see, 8,760%. One of the questions I also give students, and it's an actual example, and that is a student overdrafts their banking account paying for a pizza on Saturday, go in on Monday to pay the overdraft and find that their APR is in excess of 300%. So is APR the appropriate metric? Well, the answer, as I said before, is no. Because if you look at the installment loans that are being made and look at the 36% APR, you will note that given the amount of money that is generated in interest and the costs that have to be covered, it is very, very rare indeed for the cost of that loan to be covered by the returns when APR is fixed at 36%. Let's have the next slide. Thank you. So how can we help the customer? First, financial education and literacy are critical first steps. Second, allow the market to craft unique products designed to serve the bank and underbank, since traditional products may not be appropriate or even available in many neighborhoods. Third, expand alternative financial service activities that qualify as credit building tools, such as utility bills and rent payments. Allow the market to drive a solution, but with carefully crafted consumer protections in place. Lastly, let's look at this. We can help the consumer if we adopt state legislation to increase access to credit by encouraging these innovative approaches, pairing local not-for-profits and or depository institutions with small consumer lenders. Before adopting changes in financial statutes, in other words, before you adopt these usury ceilings, these interest rate caps, make certain that you look at both sides. You may think you're benefiting consumers, but I said the major research in this area shows very, very little help to the consumer and a lot of harm. So weigh both sides of the equation and understand you may be causing increased costs, additional hardships, serious financial stress on your consumers. And lastly, remember that the total interest paid, fee-based disclosures are more understandable and more desired by the borrower than a simple APR-based disclosure. Thank you very much.
Thank you, Dr. Black, for sharing with us today. And next, we're going to hear a little bit from Tracy Sandin at Security Finance.
Hi there, and I'm going to share my screen. Let's see if I can do this. And it would be right there. Can you, okay, and share. Are we on?
Yes.
Okay. I always surprise myself when I can get this stuff done. So I am going to talk to you today about financial literacy. And it ties in, it dovetails in with what Dr. Black was talking about. So first, what is financial literacy? Well, it provides the financial skills and knowledge to make smart money decisions that will leave a lasting impact on the individual, the family, and the community. Financial literacy is something that our industry has been pushing for a long time. If we as a society can educate kids as early as middle school on money management, imagine how powerful that will be when making their future financial decisions. Why is this so important? Let's take a look at the statistics and benefits of financial literacy programs. First, as you can see, 64% of adults admit that money is the most significant issue causing stress, especially for those with a household income level of $50,000 and below. We know 12% of adults would not have the resources to pay an unexpected expense of $400 or more. Almost 40% of adults in the US do not have $1,000 in savings, yet 60% of parents admit having to help their kids in some way during the past year. The benefits are self-evident. If more people were financially literate, there would be less stress, smarter financial decisions, and the ability to set short and long-term financial goals. Imagine how this would benefit the whole family as they share in the learning experience. There are several financial literacy programs available out there, but I'd like to focus on what I feel is one of the best programs. It's called Money Skill. This is a free online program in personal finance developed by educational experts and endorsed by teachers. It is available to anyone who wants to use it. After completion, stats show a 60% improvement in a student's understanding of how to manage personal finances. How is Money Skill taught? There are 37 training modules that students may take as assigned by an instructor or on their own at their own speed. It's available in both English and Spanish. There are pre and post tests to ensure understanding. And the program provides certificates that can be printed after each successful completion of the modules. So to give you an idea of the presentation style, here's a sample video. In the interest of time, I'll just play the first few seconds. This one is about vehicle financing.
You've decided you need a car. It can be a tremendous investment and bring a long list of benefits, but you need to enter the purchasing process with the foundational knowledge to get the right deal for your life and your finances. Once you've decided upon the type of vehicle you'd like to acquire, it's time to figure out how you'll pay for it. You basically have three feasible choices: pay all cash, which few of us can do; buy the vehicle by making monthly payments over time through an installment loan; or lease the vehicle for a period of time.
Is this effective? You bet. What's really cool is that the students who have completed money skill at the middle school level are more inclined to open checking or savings accounts by the time they're 15 or 16 years old. There are 1.3 million subscribers to this program and span all 50 states. The short and long-term benefits of their new financial knowledge gives people power to better control their future. The most effective way to help students is to teach financial literacy in the classroom. Once money skill is accepted as a teaching tool, it can be integrated as a course during class time, as a weekly homework assignment, or taken as time permits and completed before the end of the school year. It could be as easy as setting aside 10 to 15 minutes each week to discuss what students learned from their modules, what they found surprising or interesting. Another huge benefit is the fact that young students take this course, a natural conversation begins with their parents, friends, and/or guardians. This may actually generate enough interest in others who may then choose to take the course for personal knowledge. I know I ran through the subject quickly, but I wanted to leave time for any questions about financial literacy or for Dr. Black on his presentation. To learn more about Money Skill, I've added the program's contact information for Rhonda Ashburn. Thank you so much for giving us this opportunity to share what we know. I hope it has been both eye-opening and helpful. Vanessa, back to you.
Thank you very much, Tracy and Dr. Black. We appreciate the thoughtful presentations. And at this time, I would like to encourage our audience members to go ahead and type any questions or comments into the Q&A for view only by the panelists and hosts, or into the chat for view by everyone. Feel free to include your name, state, and title if you would like. And we have one, someone is asking, can you show the list of states participating? Did you say that the program is in all 50 states?
It is in some way, shape, or form in all 50 states, yes.
Okay, this is Grace Diaz, and she is saying that here in Rhode Island, we passed legislation on financial education and literacy last year. It was recommended by the Rhode Island treasurer. So thank you for that comment. And there's another question here from a legislative aide of a senator from Maryland who is writing in a question for you, Tracy.
Yes.
And I think that Sam is still typing. So I will wait for that one and go ahead with the next question that we have received. So this one is for Dr. Black. Dr. Black, when a 36% APR rate cap goes into effect, why isn't there a huge outcry by the consumers who lose access to credit?
That's a very, very interesting question. I've wondered that myself. And I think I've come to the conclusion that the people who are most affected are also people who are least likely to voice those complaints because they probably feel that they don't have much power themselves and they feel powerless. And because of that, we don't hear a concerted outcry. There's also one other issue here, and that is as Tracy says, education is tremendously important. And many of the folks who ostensibly represent poor individuals or borrowers with lower credit scores, they themselves may not be aware of the harmful effects of a 36% ceiling. What happens is you have to impose it, and then you wait to see the effects afterwards, because the effects are not immediately known. And because they don't immediately present themselves, I think we find that there's less hue and cry because of their imposition.
Okay, interesting. Thank you so much for that. And then a follow-up for the consumers who lose access to their credit. This is for Tracy. What do they do to find financial assistance in the absence of small dollar installment loans?
Well, we're getting more and more information out of the states that have passed rate caps. And so as we get those statistics in, we'll be better prepared to answer that question. But generally what happens is they turn to online lenders who are unregulated in a lot of cases. We've seen a huge uptick in states like Connecticut and where that's already been the case for a long time, South Dakota, where people are referred to gaming organizations, and also loan sharks tend to find them, not associated with Indian tribal lands, or tribal lending, but loan sharks tend to come up and find these people, or these people find them. In Texas, I was talking to a past senator who said at one time, a long time ago, when she had just started out, that this was the case, that the cartels came across the borders and were not so kind in their collection practices. So it does happen, and as Dr. Black, people just don't speak up. And I think a lot of times they're embarrassed about even having to ask for help at this level, or then in what happens to them afterwards. So it's very complex, but we're getting more statistics on that.
Okay, thank you. And then I'm going to go back to the question from Maryland. For financial literacy classes, have you noticed a difference if it is a standalone class versus if it is a part of a larger curriculum? It is not a statewide requirement in Maryland, and some counties do not have dedicated financial literacy graduation requirements. They only teach it as part of other classes.
Yeah. So as a question, is it better to teach it one way or another, or just it's not available? What I do know about the coursework is that it's very easy to do it on your own. What I think is more effective is if teachers initiate the coursework with the student, and it doesn't really have to be in the curriculum per se. All that's needed is for the teacher to say, hey, this course is available. You'll get credit for completing it. We'll talk about it maybe 10 or 15 minutes on Friday mornings in maybe econ or whatever class they choose to pull it into. And we'll talk about what you learned and what you think is very interesting about that. But they can do this on their own at home as homework. It doesn't take very long. The modules range in time from maybe 10 minutes to 15 to 20. So it's not hugely time consuming, but it's fascinating to actually take the courses. And you're all invited to sign in and take that. All you need to do is input your email, and you can start the program. And it's just you who will see all of this, but and the success that you're having with the program. And it's amazing. I mean, I've picked up a few things about buying a car. So very helpful to me.
Thank you for sharing. Feel free to drop a link in the chat if you have it handy about how to access that.
Mhm.
And the next question is for Dr. Black. Have banks and credit unions shown any interest in making these small dollar loans to subprime borrowers?
Well, very, very few banks have. There were some banks that tried to align themselves um, with small dollar lenders and ran into some regulatory constraints that did not allow that to take place. As far as credit unions are concerned, typically your community credit unions are the ones who would do this. As you know, credit unions have three types of organization structure. And typically, the community credit unions would do this. And several of them have been unsuccessful. Several of them still have these types of loans on their books. But once again, credit union membership is limited. And so you don't have the sort of wide expanse that would occur otherwise in a geographic area, because, like I say, the credit unions are limited.
Right, thank you for that. And the next question goes to Tracy. Is there any way that a 36% interest, not APR, can be used to create a loan product for the subprime borrower?
That's a really good question. Yes, there is. 36% interest is different from 36% APR, so please separate that in your minds. But a product or a loan product that starts with 36% interest can be done. The difficulty is when they try to put the monthly fees, handling fees, and underwriting charges in under that 36%. You can do a 36% loan, but you've got to have these cost factors outside of that. Otherwise, it's 36% APR all in when you include handling charges and underwriting charges. There are hard costs that companies have because a lot of us are storefront lenders. A lot of the traditional installment lenders for small dollar loans are storefront. So those are hard costs. So employees, utilities, rent, land costs, collection costs, it's all it's not cheap to do. So we need that amount on the side, and we have worked with a couple of organizations, consumer group organizations, to come up with models, and we have those. But I think people are really stuck on APR right now, so it's really been hard to get through.
All right, so I'm going to invite the audience again to type in any questions that you have as we get ready to wrap up the time together today. But I do have one other question that has come up. Where can anyone go for help answering more questions about small dollar installment loans?
You know, there's a great website, National Installment Lenders Association, NILA, N-I-L-A, and they have an extremely robust Q&A section on that website. And I would encourage anyone, everyone to go there. Highly educational. And of course, Dr. Black and I are always here to answer any other additional questions if you don't feel you have gained enough by the NILA website. That's the National Installment Lenders Association. I've also put the APS Education Foundation link in the chat, and I will do the same with NILA in just a second.
Wonderful. Well, please join me in thanking the panelists, Tracy Sandin, Senior Vice President, Government and Public Relations for Security Finance, and Dr. Harold Black, Emeritus Professor of Finance at the University of Tennessee.
Thank you.
In the coming days, this session recording will be posted on the Virtual Innovation Classroom registration page. And to help you find it or to register for our final Innovation Classroom session of the series, which will occur at 4 p.m. Eastern today, please see the link that will appear in the chat. Today at 4 p.m., the National Public Pension Coalition will be presenting a session on retirement security and the future of work. Thank you all for tuning in.